Accounting for partnership firm, and in this module we will learn how to prepare final accounts of a partnership firm. Remember, as I was discussing in one of the modules of this accounting for partnership firm, that accounting is not difficult in this partnership chapter. The difficult part was calculations. The same debit and credit we do, and in the same way we prepare income statement and balance sheet. There is only one additional statement that we work out in this partnership business, and that is profit distribution statement. Okay, so we'll see that we will be preparing three statements. Number one, income statement. Number two, the profit distribution statement. And the number three is balance sheet as it is. The concept is exactly the same to prepare all these income statement, balance sheet, or the profit distribution statement as we have already learned. Okay, so nothing is difficult, nothing is new. So relax and then see what is happening in preparing final accounts for partnership firm. Are you relaxed? Okay, let's move forward. In this practice question 16.9, there are two partners, Shazra and Sumayya, and they are sharing profits and losses in the ratio of 3:2. The trial balance on 31st March Y0 is showing a list of balances in the debit and list of balances in the credit. All right, very well. So we see both sides are equal. All right, just quickly have a look on its debit side. Opening stock, we know very well what to do. It is used in working out the cost of goods sold. Purchases, yes. Do you remember ILO? Okay, so you will work out ILO over here. Okay, I'm leaving this blank for you. So you will work out ILO. A for asset, E for, yes, expense, I for income, L for liability, and O for, yes, owner's equity. So part one of this thing is that you have to mark ILO. Okay, well, keep marking ILO. Opening stock is expense, purchase is expense, trade debtors are assets, wages of sales staff is expense, salaries of administrative staff is expense, building is asset, machinery is asset, furniture is asset, advertisement for 2 years, yes, there will be an adjustment on it. Remember, for 1 year is expense and prepayment is asset. Okay. Bills receivable. Receivable thing is asset appearing in the debit side. Okay. Well, insurance premium is expense. Drawings by Shazra. Yes, owner's equity, contra item. And drawings by Sumayya. Yes, owner's equity, contra item. Okay. And cash in hand is asset. Repair and maintenance is expense. Utility bills are expense. So you have marked A and E and here O. Okay, well, come on. This is capital account of Shazra and capital account of Sumayya. So both are O. Okay, owner's equity. Well, sales is I, income. Trade creditors liability, bills payable are liability. And this discount appearing in the credit side is income. Because anything appearing in the credit side can never be expense. It is I for income. So you have marked ILO. Good. Let's move forward. And there are few adjustments. We have closing stock with us. It will affect our cost of goods sold and it will be taken to the asset. Well, we have to write off 2,000 for further bad debts. We know this accounting entry, bad debts debit, and our debtors account will be credited. And we have to maintain provision for doubtful debt at 5% on debtors. So for this, if there is increase in provision, bad debts debit and provision for doubtful debts will be credited. And in case of decrease, vice versa. Depreciate building at 5%. machinery at 10%, and furniture at 10%. Simply, we will calculate this percentage, and depreciation expense will be taken in the income statement as an expense, and its credit effect means the provision for depreciation account will be subtracted from the respective assets. Outstanding expenses for wages 2,000. It will be included in the wages expense and will be taken as a liability in the balance sheet. For salaries 1,000, it will be taken in the expenses, salary, and a liability in the balance sheet. Then prepaid repair is 1,600. It will be subtracted from the repair expense and will be taken to the balance sheet asset. Okay, so keep marking I low along with these 1, 2, 3, 4, 5. And sixth one is there is an adjustment required in purchases for 4,000 were not recorded in the books of accounts. So it will be added in purchases and will be taken to the creditors as a liability. We have not recorded these credit purchases. Okay, well, and it was decided that there will be no interest on capital and drawings. Okay, that's very fine. And both partners are entitled to annual salary. Shazra 15,000 and Sumayya 10,000. Okay, that's very well. So from the above trial balance, we have to prepare income statement for the year ending 31st March and balance sheet as on that date. So let's see that in the income statement, sales, obviously we are taking from the trial balance, opening stock is there, purchases are there, but there is an adjustment on purchases, okay, 4,000. So these were unrecorded purchases, add this, total purchase will become this. And then there is an adjustment of closing stock as well. So this closing stock we know is subtracted in this cost of goods sold figure so that we get 149,000 and the gross profit is 71,000. Okay, so it's easy, nothing new, all fine. Okay, let's move forward. Gross profit is 71,000. We took it from here and put it over here. All right. And other income, which is the discount received, we remember that it was appearing in our trial balance credit side. So discount received 6,500 is there. All right. Well, it's done. Then wages, staff, sales staff wages. Okay. There is an adjustment on that. So outstanding wages we will add. So that total is 7,000. Then salaries 10,000 and there is an adjustment on that. 1,000 outstanding salaries add. It will be 11,000. Then advertisement, there is an adjustment in that because advertisement was for 2 years. 1 year adjustment is prepaid. So will be remaining 3,000 are expense and this 3,000 will be taken to the balance sheet asset. Then insurance as it is. Repair, there is a prepaid repair 1,600 will be subtracted from here and will be taken to the balance sheet asset. All right. So now depreciation. We have to work out this depreciation as given in the adjustments. And then bad debts and increase in provision for doubtful debts is also an adjustment. So by making all these adjustments, we have net profit which is available for distribution to the partners. Okay. This 35,000 we have to distribute among the partners according to the ratio given in the question. And this is how we will be preparing profit distribution statement for this year. So we have two partners, Shazra and Sumayya. So we have net profit of 35,000 to be distributed among Shazra and Sumayya. Partner's salary is 15,000 and 10,000. So again, I remind you that partner's salary is not an expense. It is a reason for distributing this 35,000 among the partners. So out of this 35,000, 25,000 is being distributed among the partners in their ratio of salary. All right. The remaining 10,000 will be distributed in their agreed profit sharing ratio, which is 3, 5 and 2, 5. So it is 6,000 and 4,000. So the balance is nil. It is the amount of owner's equity or the profit that we have to distribute to the partners and will be taken to the owner's equity of the respective partners, 21,000 and 14,000. Let's see how this balance sheet will be worked out. So we have all these information in the trial balance. We are very much familiar and confident on all these figures. Non-current assets, building is there appearing in the trial balance along with depreciation that will be subtracted from it because this was given in the adjustment. So this accumulated depreciation will be subtracted. We'll get 28,500. Machinery we are taking from the trial balance and depreciation from the adjustment. Balancing figure 22,500. Furniture in the same way. So altogether total non-current asset is 65,400. Current assets include closing stock, which was given in the adjustment as well and which was worked out in cost of goods sold. Trade debtors are given. Further bad debts we have to subtract and provision for doubtful debts we have to subtract. Balancing is 9,500. Now these adjustments, prepaid advertisement, prepaid repair, this we have to show here, and bills receivable and cash in hand. Altogether we have total assets of 98,000. Non-current assets and current assets, total 98,000. Let's see its owner's equity. We have this capital appearing in the trial balance, okay? Profit share of Shazra and profit share of Sumayya will be added along with their drawings will be subtracted. So these drawings will be subtracted and the balancing figure of capital account of the partners is 29,000 for Shazra and 21,000 for Sumayya. So total is 50,000. Liability is creditors 21,000 and unrecorded purchases which we could not record and it was given in the adjustment. Now recorded, there is a liability of 4,000 to be included in creditors. So total liability is 25,000 for the creditors. Bills payable is liability 20,000. Outstanding wages, we took it from the adjustment. It's liability and outstanding salaries. So that total 48,000 is our liability and altogether the balance sheet is 98,000. If you see this 98,000, which is the sum of owner's equity and liability, is equal to the 98,000, which is sum of the non-current assets and current assets. All right. So this is what we have learned in terms of our partnership. And this is the final thing that we are done with the final account of the partnership firm. So you know what is the tip to remember? Yes. Do some more practice. You have to practice. Because if you will not practice, you will not be perfect in your knowledge. All right? Thank you.